Nicholas Galluccio is the president and CEO of Teton Advisors, Inc., an affiliate of Galluccio Investors, Inc. Teton was spun off from Galluccio in 2009. Since 2008, he has managed the Galluccio Westwood Small Cap Equity Fund. Prior to Teton, Mr. Galluccio had an accomplished 25-year career at Trust Company of the West, where he held various executive roles. He holds an MBA from Columbia Business School, an MA from Columbia University, and a BA from the University of Hartford. Mr. Galluccio has been featured in numerous financial publications such as Barron's and is a columnist at Forbes magazine.
A key investment question many investors ask themselves is, should I go passive or active? And by that I mean, should I have an active manager manage my portfolio, or should I put my money in ETFs or index funds? We're here to tell you that active management is the way to go. And the reason we say that, especially in small cap, is that small cap stocks are very inefficient relative to large cap stocks. As you move down in liquidity, you get more inefficient pricing. As you move up in liquidity, you have more efficient pricing. And given what's happened to markets in the past few years, you've seen a drubbing of small cap companies to very, very cheap prices. And the inefficiencies that are created by the market dropping and by the liquidity coming out of the market has allowed us to go in and kick the tires and find some real bargains in the small cap world. The recent environment has led to indiscriminate selling of good companies to fire sale prices. And these dislocations and these inefficiencies that have been created in the market decline have really cast a cloud over the idea that markets are efficiently priced. We at Teton Advisors believe markets are very inefficient and that there's enormous opportunity as you move down in liquidity. We have seen unprecedented market volatility in the past couple of years, and today it is not surprising to see stocks turn over many times in a year in anyone's portfolio. If you go back 75 years, the typical stock turnover in a mutual fund was 25%. Today, the average turnover in a mutual fund portfolio is close to 90%. Certain hedge funds turn themselves over 5-6 times. And this has exacerbated the volatility created by, high-frequency trading and the like. So all of this, of course, gives many reason to pause about why they want to be in the market. In fact, many small investors have become somewhat disenfranchised by all the trading and the volatility. The increased volatility, while unnerving, has afforded investors the best risk-reward opportunity in the past 10 years. The trend of cheap valuations created in the wake of market meltdowns has forced the average investor to spend more time focusing on fundamentals. And that's what we do here. We basically look at companies' balance sheets first. We look for cash. We look for cash flow, business models, quality of management, and market position. And the reason we're so attracted to small caps right now is if you look at the past 15 years, the valuations are as cheap as we've seen them. For instance, the P/E ratio on the Russell 2000, which is the benchmark for small caps, is at around 12.5 times earnings compared to over 15 times earnings historically. The cash flow multiple of the Russell 2000 is selling at somewhere below 9 times earnings compared to 12 historically. Price to book value is 1.5 times versus 2.2 over the past 15-year average. And the most compelling case for small caps is the balance sheets are rich with cash. Nearly 20% of the index is sitting in cash. By that I mean if you took the market capitalization of the entire index, 20% of the market capitalization of the Russell 2000 is sitting in cash. So we think this is an opportune time to refocus on company fundamentals, to forget the pain and suffering caused by the stocks declining in the wake of the market meltdown, and to sort of start deciding where you want to place your bets for the next recovery cycle. Small cap managers generally have an inherently better chance of outperforming large and mid cap managers, and there's historical precedent for this statement, and that is reflected in the Ibbotson study, which was the seminal study comparing small caps to other market capitalizations over the period from 1926 through 1996. And in that period of time, it showed that small caps outperformed in every period, 25, 15, 10-year periods. That gets me back to the inefficiencies in small cap companies. All of us know there's been an incredible contraction in the financial services industry over the past 3 years. That has caused research departments to cut the number of analysts who follow small cap companies. Small cap companies, by their very nature, are illiquid and do not trade very well. And when you reduce the sell-side research coverage, this exacerbates the lack of trading in these companies. That creates the opportunity for us to step in there and uncover the hidden gems of excellent companies selling at 15-year low prices. And that's what we do for a living. Just as you would expect from a diehard active value manager, we pour through SEC filings, we gather data, array data, project the data, and try to determine what a company's worth. We're buying companies at a discount to their intrinsic value, and in many cases this does not exclude growth stocks. We love buying companies that can grow, and that as long as we're not paying a high multiple for that growth rate. So the portfolios that we manage have value stocks and growth stocks, but the growth stocks are selling at value prices. This is a very good time for the average investor to go out and comb through the rubble of the market meltdown and look for hidden gems of companies. I subscribe to the Peter Lynch thesis of buy what you know. Peter was the famed portfolio manager for the Magellan Fund who compiled an excellent track record over many years of fidelity. And he would always say, buy what you know, and we buy what we know. The major validation of everything I've said today is reflected in the fact that we're seeing a wave of takeover activity that's sweeping small cap companies. Over the past 3 years, we've had a near record number of mergers and acquisitions by strategic buyers buying companies for bolt-on acquisitions, as well as LBO and private equity firms stepping up and taking advantage of the low interest rate environment to buy small cap companies. Last year, 70% of the deals were in companies with market capitalizations under $5 billion. And this year, the deal activity continues. Every week, there's an announcement of another merger. Small cap managers generally have an inherently better chance of outperforming the overall market by taking advantage of inefficiencies in under-researched and misunderstood companies. While no one can claim absolute victory in the active versus passive debate, one thing is clear. The seismic change reshaping the investment landscape will leave its indelible mark for many years to come. I'm Nick Galluccio, President and CEO of Teton Advisors, a specialty small cap boutique asset manager.
Teton Advisors, Inc. is the investment manager for all Galluccio Westwood funds. Past performance is no guarantee of future results. Investment return and principal value will fluctuate, so upon redemption, shares may be worth more or less than their original cost. To obtain the most recent month-end performance information and a prospectus, please call 1-800-WESTWOOD or visit www.tetonadv.com. The Russell 2000 Index is an unmanaged index of 2,000 small-cap U.S. stocks that is generally considered to be representative of small capitalization issues in the U.S. stock market. The Russell 2000 Index is not available for direct investment. Small capitalization stocks are subject to significant price fluctuations and business risks. The stocks of smaller companies may trade less frequently and experience more abrupt price movements than stocks of larger companies. Therefore, investing in this sector involves special challenges. Securities of smaller companies present greater risks than securities of larger, more established companies. Investors should consider the investment objectives, risks, charges, and expenses of the funds carefully before investing. The prospectus, which contains more information about this and other matters, should be read carefully before investing. Not FDIC insured, not bank guaranteed, may lose value. Teton Advisors Mutual Funds are distributed by G. Distributors LLC, 1 Corporate Center, Rye, New York 10580. For prospectus, current performance, and additional information, visit our website at www.tetonadv.com or call 914-457-1070, 1-800-WESTWOOD, or email info@tetonadv.com.